Losing Palantir hurt. But the greatest danger is not having lost Palantir. The greatest danger is what that regret makes you do now. Because when you see a stock go up without you doing anything about it, something changes in your mind. You start to remember all the moments. I saw that stock at $6. I almost bought it. I had her on my list. I bought it but sold it early. I thought it was expensive. I thought it was too controversial. I thought I had already climbed very high. And then the market does something even more dangerous. He puts another action in front of him. Another name for artificial intelligence. Another chart going up. Another video saying that this is the next Palantir. And suddenly you're no longer investing. You're trying to erase a regret. That's where a lot of people lose money. Not because he missed his first big opportunity. But why try to compensate for that pain by rushing into the next story? At the wrong price, without a plan, without a thesis, and without knowing what to do if the stock falls 30%, 40%, or 50%. If you lost Palantir, you're not alone. Many intelligent people lost out. Many patients have died. Many people looked at the company, looked at the controversy, looked at the valuation, looked at the chart and thought, I am going to wait. And then she continued climbing. But here's the truth that almost no one wants to talk about. Losing Palantir isn't the mistake that destroys an investor. The mistake that destroys an investor is letting Palantir turn you into a gambler. Because right now, you're not looking for a company. You are seeking revenge. You're looking for the ticker that will make you feel like you've made up for lost time. And that's exactly when the market becomes most dangerous. Before we delve into the framework, if you're serious about becoming a smarter, long-term investor, and not just someone chasing hype, subscribe to the channel. I'm building this channel for people who want to understand the market, not gamble on it. Now let's talk honestly. I know what you might be thinking. These stocks have already risen too much. I don't have enough money. What if I'm buying at the peak? What if I'm just an exit liquidity for those who arrived earlier? What if artificial intelligence is a bubble? What if I buy and it drops 40%? Should I buy individual stocks or ETFs? What if the easy money has already been made? These aren't bad questions. In fact, those are the right questions. The problem isn't being afraid. The problem is having fear at the wrong time and courage at the wrong time. Many people hesitate when they should be studying. Then he runs when he should be thinking. Ignore a company when it is still poorly understood. Then they want to buy it when everyone on YouTube, Twitter, Reddit, and CNBC is already talking about it. That's not strategy. That's emotion. Whether you have $300 a month, $1,000, $10,000, or a small retirement account, you can't afford to invest based on emotion. You don't need to get everything right. You don't need to pick every big winner. You don't need to discover the next Palantir before the rest of the world. But you need a process. Because in this cycle of artificial intelligence, there will be real winners. And there will also be real traps. There will be excellent companies with poor entry fees. There will be expensive stocks that continue to win for years. There will be cheap stocks that remain cheap because the business is weak. There will be companies building the real infrastructure of the artificial intelligence economy. And there will be companies simply putting AI in their marketing because they know that retail investors are paying attention. Your job isn't to chase after every ticket. Your job is to separate the signal from the noise. And the first mistake investors make after losing a stock like Palantir is looking for the next Palantir. I know that sounds logical. If a stock market crashed, the natural question is, what's next before it happens? But this question can poison your decision-making. Because when you're looking for the next Palantir, you often stop analyzing a company for what it truly is. You start looking for an emotional replacement. An action that seems premature, an action that seems cheap, an action that seems misunderstood. An action that makes you feel that there's still time to recover what you've lost. But the market doesn't owe you a second version of the same story. The next big opportunity might not look like Palantir. Perhaps it's not in the same sector. Perhaps it doesn't have the same graph. Perhaps it doesn't have the same narrative. Perhaps it's not even an individual action. It may be in the infrastructure. It might be in terms of energy. It may be in semiconductors. It could be in the cloud. It could be a cybersecurity issue. It could be in industrial automation. It could be in boring companies that are lagging behind the artificial intelligence boom, while everyone else is chasing the most eye-catching name. The mistake is thinking you need to find a small, cheap, and explosive action before everyone else. That's a lottery mentality. What you really need to find is a secular trend, a company with a competitive advantage, a clear role in the ecosystem, a valuation that makes sense, and an entry plan that doesn't depend on emotion. Palantir didn't work just because it was cheap. It worked because for a long time the market didn't fully understand what it was becoming. That's the key. The opportunity was not simply the stock fell. Many stocks fall and never recover. Many stocks seem cheap because the business is failing. Many actions are hated because they deserve to be hated. Low price is not an opportunity. A destroyed chart is not an opportunity. An enthusiastic online community is not an opportunity. A charismatic CEO is not an opportunity. An opportunity arises when the market underestimates the future economics of a business. And that's much harder than finding a ticker that hasn't gone up yet. So the right question is not, what's the next Palantir? The right question is, what is it that the market still doesn't understand? The market is treating this company as a hype when it's actually becoming critical infrastructure. The market is treating this company as cyclical hardware. When is it becoming a platform? Is the market ignoring margins? Are you ignoring switching costs? Are you ignoring long-term contracts? Are you ignoring the fact that this product could become an essential part of your customer's workflow? That's where real investing begins. Not with a ticker, with a thesis. And a thesis is not to say, AI is the future. That's too generic. Everyone already knows that AI is important. A true thesis is specific. She says, this company has a role in the artificial intelligence economy that could become more valuable over time. And perhaps the market isn't pricing that incorrectly yet. One thesis answers, who pays for this? Why are you still paying? Why might this company win? What could possibly go wrong? What would make me change my mind? This last question is crucial, because if nothing can change your mind, you lack conviction. You are attached, and attachment is expensive. So before looking for the next Palantir, stop and ask yourself, am I buying a company, or am I buying into the feeling that there's still time? This question could save you a lot of money. Because after you lose a big winner, the regret runs high, envy is running high, fear is rampant, and when emotions run high, standards fall low. You start accepting weak arguments. He's starting to call speculation conviction. It begins to be called concentration of courage. Start calling FOMO research. And the next big mistake might not be missing another opportunity. Perhaps it's trying to recover from regret too quickly. Hurry seems like a good thing right now. But rushing things without due process destroys small investors. And that leads us to the next mistake. Confusing the price of a stock with the value of a company. The second mistake is confusing the stock price with the company's value. And this mistake mainly affects small investors. A person looks at a $300 stock and thinks, I can't buy that. Then he looks at an $8 stock and thinks, I can do this one. But that's an illusion. An $8 stock is not automatically cheap. And a $300 stock isn't automatically expensive. The share price is just the price of a slice. He doesn't say how big the company is. He doesn't say how much the company sells. He doesn't say how much money she generates. He doesn't say if she has any debt. He doesn't say whether it dilutes shareholders. He doesn't say if she has any margin. He doesn't say whether she has a competitive advantage. He doesn't say whether the market has already priced perfection into the market. What matters is valuation, market cap, revenue growth, margins, free cash flow, balance, moat, dilution, quality of management. And that's the price you're paying today for the future you believe this company can deliver. That's the point. The problem isn't that a stock costs $300. The problem is buying any company without understanding what you're paying for. And today, with fractional shares, that argument has become even weaker. If your brokerage allows you to buy fractional shares, you don't need to buy a whole share. You can deposit $20, $50, or $100. So the question is not, can I buy a whole share? The question is, does this company deserve a place in my portfolio at this valuation? This changes everything. Because if you only look at the stock price, you might end up avoiding excellent companies just because they seem expensive. And you might end up buying bad companies just because they seem affordable. That's not investing. This is reacting to a number on the screen. And the market loves to hide risk behind simple numbers. An action may seem cheap, but be extremely expensive. An action might seem expensive and still make sense if the business is growing, expanding margins, gaining market share, and becoming more essential. Now, be careful. This doesn't mean that valuation doesn't matter. Valuation matters a lot. In fact, valuation is one of the biggest reasons why investors get wiped out in hype cycles. But valuation is not the same as stock price. Valuation is how much you are paying in relation to what the company can produce over time. And in artificial intelligence, this is even more important. Because AI is not a casino table. AI is becoming the new power grid of the economy. Some companies are building the wires, some are selling the meters, some are operating the plants, some are protecting the network against attacks, some are cooling the system so that it doesn't overheat, and some are just selling neon signs outside the casino. That's the difference. There are companies that are real infrastructure. There are companies that are fragile applications. There are companies that are essential. There are companies that are optional. There are companies building the layer that everyone will depend on. And there are companies that only use the word AI because they know the market is paying for that narrative. If you don't know how to differentiate one thing from another, the stock price isn't going to save you. A cheap action can be a trap. Because if a company doesn't have moat, doesn't have pricing power, doesn't have cash flow, doesn't have repeat customers, doesn't have a strong balance sheet, and doesn't have a clear role within the AI economy, what are you buying? You are buying a story, and stories can drive action for a while. But businesses are what create value in the long term. This is the line you need to respect. The market can reward a story for months, sometimes for years. But at some point, the numbers need to come in. The revenue needs to be generated. Margins need to be visible. Cash flow needs to be visible. Customer retention needs to be addressed. Execution needs to show. If that doesn't appear, the stock doesn't just fall, the story breaks down. And when the story breaks down, the retail investor is usually the last one defending the thesis. Because he didn't buy the business, he bought the dream. Now let's move on to the third mistake. Buying something that has already gone up in price without understanding why it went up. And here I want to be fair. When someone comments, "These stocks have already risen 200%, 300%, 400%. This person is not being stupid. She's right to be careful. You should be careful. Because yes, often when everyone is talking about a stock, much of the optimism is already priced in. Sometimes the company is excellent, but the entrance is bad. And that difference is fundamental. A large company doesn't necessarily mean a large entry point. A company can be wonderful and still be priced for perfection. And when a stock is priced to perfection, it doesn't need to fail to fall. She just needs to stop surprising us. She just needs to grow a little less, guide a little below, to have a slightly smaller margin, losing a contract, facing a slowdown. And suddenly the market that was paying for perfection starts to recalculate. That's why you need to separate the two questions. First, is this a large company? Second, is this a good entry point? These questions are not the same thing. Many people get the first one right and the second one wrong, and then blame the market. But the problem wasn't the company. The problem was buying it without a plan. Before investing in any stock that has already risen significantly, ask yourself some simple questions. Is the business still accelerating? Does valuation assume perfection? Is the company essential to its customers? Is there a risk of customer concentration? Can the margins expand? Does the company generate cash or does it depend on a narrative? What happens if the stock price falls 40%? Would I buy more or would I panic? That last question is brutal, because it reveals whether you have a thesis or just enthusiasm. If a 40% drop would make you sell desperately, perhaps the problem isn't the stock itself. Perhaps the problem is the size of the position. Perhaps the problem is a lack of education. Perhaps the problem is that you bought because the chart went up, not because you understood the business. Even a large company can be a terrible operation if you don't have a plan. And a great opportunity can still turn into a mistake if you invest the wrong amount of money at the wrong time and with the wrong expectations. This brings us to the fourth mistake. Wanting a ticket, not a system. I know the question many people want to ask is, so what action is it? That's an understandable question, but it is incomplete, because a ticker without a thesis is just a lottery ticket with a stock symbol. The better question is, what role does this company play in the artificial intelligence economy? What would make me buy it? What would make me wait? What would make me sell? What should the position size be? What risk am I really taking? And that's the point where the investor needs to move away from a ticker-chasing mentality and towards a portfolio-building mentality. Because AI is not a single category. You can look at infrastructure, energy, electric grid, cooling, semiconductors, networking, cloud, data, cybersecurity, automation, robotics, AI industrial, uranium and nuclear power, rare earths and metals, software platforms, and AI ETFs for more diversified exposure. But the goal isn't to make a giant list and then go out and buy everything. That's also a mistake. The goal is to understand the role of each category. Some companies provide the foundation. Some of them accelerate productivity. Some protect the systems. Some capture data. Some sell tools. Some rely on hype. Some can be replaced. Some become indispensable. The filter matters more than the list. Because if you only want a ticket, you're outsourcing your decision. You're asking someone else to choose for you. And the problem is that you'll also want to outsource your conviction when the stock falls. But conviction isn't something you borrow from YouTube. You need to build. And that brings us to the fifth mistake. Ignore position size. This error is silent. But he destroys a lot of people. Because sometimes the investor does find a good company. He even understands the argument. He even buys something with potential. But put in too much money. Or put in money that you'll need soon. Either you focus everything on a single story because you want to recover what you've lost. That's not courage. This is recklessness disguised as conviction. If you have $300 a month, your plan needs to respect that. If you have $1,000, your plan needs to respect that. If you have $10,000, your plan needs to respect that. There is no perfect allocation for everyone. But there is a principle. The size of your position needs to allow you to survive the mistake. Because you're going to make a mistake. Every investor makes mistakes. The difference is that good investors make mistakes in a way that doesn't take them out of the game. For some investors, using an ETF as an underlying asset might make more sense. For others, a small basket of individual stocks might make sense. For others, the best decision may be to study more, accumulate cash, and wait for better opportunities. It depends on the age. From income, from the time horizon, from tolerance to risk, based on the size of the portfolio. And it's about the emotional capacity to see a position fall apart without destroying one's own plan. The core and satellite concept helps. The core is the part that gives structure to the portfolio. It could be more diverse, more stable, more aligned with the long term. Satellite is where the most convincing arguments come into play. Individual actions, specific topics, companies with higher volatility. But the satellite must not destroy the core. A thesis should not put your financial life at risk. You don't need to try to get rich by Friday. You need to stay in the game when the real effect of compound interest begins. Comment below. Which stock do you most regret not buying, and which stock are you afraid you're already too late to buy? And if this framework is helping you think more clearly instead of emotionally, leave a like so that this reaches more investors who need to hear this message. Because the truth is simple. You have no control over whether you'll find the next big winner. But it's up to you whether you go into it with a plan or out of desperation. And now we need to talk about the mistake that separates those who have a theory from those who only have hope. Not having a plan for the downfall. The sixth mistake is not having a plan for the fall. This is one of the most important questions in the entire video. What if I buy and it drops 40%? This question isn't about fear. That's maturity. Because anyone who made a lot of money in a stock like Palantir had to go through volatility, doubt, drawdowns, criticism, negative headlines, and moments when it seemed like the thesis was wrong. But there is a huge difference here. Conviction is not stubbornness. Conviction is knowing why you possess something. Stubbornness is continuing to hold on just because you don't want to admit you were wrong. If the stock falls, you need to know what's happening. Does the thesis still stand? Or has the thesis been broken? Is the company still growing? Or has growth slowed down structurally? Are the margins continuing to improve? Or has the story of future profits begun to weaken? Did the drop occur because the entire market fell? Or because something specific changed in the business? This changes everything. If the thesis remains intact, a drop could simply be volatility. Perhaps this is an opportunity to hold on. Perhaps this is an opportunity to buy little by little. But if the thesis has failed, remaining inactive is not conviction. It's negation. If the valuation has become absurd, perhaps reducing it a bit makes sense. If the position has become too large, rebalancing might be a risk management strategy. If you don't know what you would do in a 30% or 40% drop, maybe you're not ready to put a lot of money into that idea yet. The market doesn't test your intelligence first, he tests your temperament. If you can only hold a stock while it's going up, you don't have a thesis. You have enthusiasm. If you bought it because someone on YouTube said so, you lack conviction. You have an addiction. If a normal drop in a growth stock completely knocks you out of the game, maybe the problem was never the stock itself. Perhaps the problem was the size of the position. This video is not financial advice. You need to make your own decisions, according to your reality, your risk profile, your income, your age, and your time horizon. But one thing is universal. You need to know what you would do before the fall happens. Because after the fall happens, you're no longer thinking clearly. You are trying to survive emotionally. And that's where many people sell at the bottom, buy at the top, change their investment strategy every week, and turn a good opportunity into a terrible result. The seventh mistake is ignoring ethics, political risk, and reputation. And here I want to be very clear. Some investors will never touch Palantir for ethical reasons. That's valid. Your portfolio needs to align with your values. You don't need to invest in a company that keeps you up at night. Financial return is not the only variable. Regulatory risk matters, political risk matters, reputational risk matters, moral hazard matters. And you should never outsource your conscience to a stock chart. Just because a company's performance is very high doesn't mean it's right for you. Just because a company is popular doesn't mean you have to own it. Just because a company has a strong thesis doesn't mean it aligns with its values. The artificial intelligence economy is large enough to allow for various forms of exposure. Infrastructure, energy, semiconductors, networking, cloud, cooling, software, cybersecurity, automation, robotics, industrial suppliers, ETFs. You don't have to buy something that conflicts with your conscience just because other people made money from it. The goal is not to copy someone else's portfolio. The goal is to build a portfolio that you understand, that you can manage, and that makes sense for your life. Now let's put it all together into a simple framework. I would call this the 5C framework. 5 questions to ask yourself before you turn regret into a decision. First C, category. Category. Is the company in an area that is truly critical to the AI economy? Or is she just using AI in her speech? Does it provide infrastructure? Does it reduce costs? Does it increase productivity? Does it protect systems? Does it move data? Does it provide energy? Does it solve a problem that will only get bigger in the coming years? If the answer is no, be careful. Not every company that uses AI in its presentation is an AI company. Second C, competitive moat, competitive advantage. Why this company? Why would she win? Does she have better data? Better distribution? Better technology? Scale? Long-term contracts? Switching costs, infrastructure, relationships with major clients, or could it be easily replaced by another company with more capital, more talent, and wider distribution? A good story without a moat can still go viral, but it's difficult to sustain value for many years. Third C, cash flow, box. Does the company make money? Are the margins improving? Is cash flow getting stronger? Or does the company depend on issuing shares, debt, and market enthusiasm to stay afloat? Growth matters, but the quality of growth matters even more. Revenue without profit margin can become a problem. Growth without cash flow can lead to dilution. History without numbers can lead to downfall. Quarto C, cost of entry, entry fee. What are you paying for? Has the market already priced in perfection? Is there any margin of safety? Does the growth justify the valuation? Or are you paying today for a perfect future that may never happen? This is the question that separates a good company from a good purchase. Because an excellent company can be a bad investment if you're willing to pay any price. And a good company can generate excellent returns if market expectations are too low. Price matters, but not as an isolated number on the screen. Price matters in relation to value. Quinto C, conviction plan. Plan of conviction. What do you do if it drops 40%? What do you do when you bend over? What do you do if the thesis fails? What is the maximum position size? When would it make sense to downsize? When would it make sense to buy more? When would it make sense to leave? If you can't answer these questions before you buy, you're not investing, you're improvising. And improvising with real money is expensive. This checklist won't make you get everything right. It does nothing, but it can prevent you from making emotional mistakes with real money. And perhaps that is the greatest lesson of Palantir. Losing Palantir hurts because it feels like you've lost a different life. Perhaps you saw the stock at $6, for $8, for $10, for $20. Perhaps I bought and sold too early. Maybe he didn't have any money. Perhaps he was afraid. Perhaps you thought it was expensive. Perhaps I've listened to the wrong people. Perhaps you saw other people winning and felt you were falling behind. I understand, but the lesson is not to go looking for another lottery ticket. The lesson is to study trends before reaching a consensus, build your position with patience, surviving volatility, control the size, understanding valuation, avoid FOMO, and don't let regret turn into recklessness. The market will always offer another opportunity. But it won't protect you from your own impatience. You don't need to collect all of Palantir. You need to stop making the same mistake every cycle. Because every cycle has a narrative. Every cycle has a stock that everyone wishes they had bought sooner. Every cycle has gurus claiming they've found the next one. Every cycle has investors who are lagging behind, trying to make up for lost time. And every cycle punishes those who confuse urgency with strategy. So, if you missed Palantir, that's okay. This is not the end of your story as an investor. But chasing the next one without a plan can be the mistake that really costs you dearly. A second chance is not a specific action. The second chance is to become the type of investor who knows what they're doing before clicking buy. If this video helped you think more clearly before buying any stock due to FOMO, comment below. What opportunity did you miss and what decision are you trying to make now? And if this message resonated with you, leave a like so it reaches more investors who need to hear this before making an emotional mistake. And if you want to continue, watch the video that's playing on the screen now, because in it I analyze another opportunity that many investors are probably viewing incorrectly. Losing Palantir wasn't the end. But trying to compensate for that regret without a thesis, without allocation, without valuation, and without a plan may be the mistake you can't afford to make.